Good morning, and thank you all for joining us. My name is Virginia Holmes, and I'm Chair of the Board of Murray International. The main purpose of today is to allow you to hear directly from the company's investment managers, and I'm delighted to be joined by Martin Conaghan and Samantha Fitzpatrick. After their presentation, there will be an opportunity to ask questions of both them and me. The Q&A session will be moderated by Evan Bruce Gardine, who's the company's client director at Aberdeen. A number of you have already submitted questions, for which many thanks. Please do send in additional questions at any time during this session by clicking the speech bubble at the top left-hand side of your screen. If you have any technical problems, you can test your connection or try an alternative stream by pressing the button below the video. Alternatively, you can report issues via the speech bubble and staff will try to assist. Before I hand over to the investment managers, I would also like to invite you to attend the company's annual general meeting, which will be held on Thursday, 23rd April. Full details of this are set out in our annual report, which has been sent to our shareholders and is also available on our website. If you're unable to attend the AGM in person, I would strongly encourage you to exercise your vote ahead of it. Voting for or against proposed resolutions is an important way for shareholders to make their views known. And full details on how to vote, including by proxy or through an investment platform, are set out in the AGM documentation. Thank you for your continued support, and I look forward to answering your questions later in the session. With that, I'll hand over to Samantha.
Thank you, Virginia. I am Samantha Fitzpatrick, one of the co-managers of Murray International. I will begin this review of 2025 by having a look at the performance of the trust, and then I will hand over to Marty to take you through positioning and then finish with an outlook, which is always the most tricky part of this sort of presentation. So moving on to the first slide, please. We begin, as always, with a reminder of what the investment objective of the trust is, and look to see, in terms of this different component parts, how we've done over the course of the year. But it's fair to say that 2025 was a very strong year for Murray International, both in absolute and in relative terms. And that was despite a really tricky backdrop at times, volatile, uncertain, and we kind of continue with that at the moment. In terms of trying to achieve an above average dividend yield, we did manage to maintain that throughout the course of 2025. The trust finished the year with a dividend yield of 3.7%, which is at the lower end of this band. If you look at that blue line at the top, you can see where we've been over the past, 15 years or so. And that was largely to do with the extent of the total share price performance last year. The share price was up 36% in 2025, which naturally meant that dividend yield compressed slightly. We did manage to achieve a covered dividend, which is another important component of what we're trying to achieve. And that just means that we seek to generate income from the underlying investments in order to pay income out to our shareholders. So dividend cover last year was 1.12 times, meaning that we could put 11 million into reserves, and reserves at the end of the year stood at 85 million. We have now achieved 21 consecutive years of dividend growth, which is very pleasing. And the track record of dividend growth in real terms over time also stacks up pretty well. We did manage to achieve real dividend growth last year of 5%. And in terms of the track record, we have achieved 16 of the past 21 years in delivering dividend growth higher than inflation. That was a similar story for the total NAV return last year, which was up 21.9%. And looking at that again over the longer term, the average annualized return for the past 21 years was 10%. It's a pretty solid story overall. The next slide breaks that down, that track record, into the various calendar years. So again, just touching on the various components. You can see, as I mentioned, the total NAV return of the trust stood at 21.9%, and that compares to the benchmark return of 12.6%. The dividend for the year, assuming that the final dividend is approved by shareholders at the AGM, is 12.4 pence, compared to the revenue per share figure of 13.9. So as I say, that meant we could put money into reserves and gives us a healthy dividend cover ratio for the year. Dividend growth 5%, as I mentioned, above the retail price index of 4.2, and it has been really pleasing to get back to real dividend growth. The next few slides break down that total NAV return into the different component parts. And so the trust remains very well diversified. We are having exposure to 51 different companies as at the end of the year, 5 bonds on top of that, covering about 24 countries. All of these weights, as you can see on this slide, are just really a summation of where we're seeing good opportunities at the stock level, with an eye on the trust being very well diversified at all times. But the best category, if you want to break it down into segments like this, was in Latin America. This was the strongest market category overall last year, and having decent exposure there, just under 8% of the trust, was certainly beneficial. We have 5 Latin American holdings at present, 2 companies in Brazil and 3 in Mexico, and a number of those performed very strongly last year. For example, Vale, the iron ore operator based in Brazil, was a very strong performer, up 55% in sterling terms. Another name to mention within that category is Grupo Asur, the Mexican airport operator, which generated total returns of 33% in 2025. Asian equities was another strong category for the trust, and within that part of the portfolio, we have a number of technology names. Things like Samsung Electronics were extremely strong performers. That one almost doubled over the course of the year. And also TSMC, a very long-term holding for the trust. We've held this one actually for about 25 years now. That delivered very strong returns over the course of the year also. But other names like Singtel, one of our telecommunications stocks, was another very strong contributor at the stock level. Europe was another positive category, and it was a whole host of different companies performing well last year. Companies such as Enel, the Italian energy company, had a very strong 2025. Siemens, the German industrial, was also one of the stronger performers. North American equities, we've got actually the highest that we've ever had in North America just now at just under 31%, was another strong contributor overall, but there were some various moving parts within North America. So again, within there, we do have some technology exposure. Broadcom was a very decent performer for us last year on a total return basis. And one of our tobacco companies, Philip Morris, proved to be very robust and defensive, especially in the first part of the year around the Liberation Day volatility. Within North America, we do have exposure to a number of healthcare names which lagged the markets overall. And also one of our Canadian telecoms companies, TELUS, was a disappointing holding for us over the calendar year. So that was offsetting some strength elsewhere. UK equities was a strong category in terms of market performance, and we still delivered positive returns there. But again, there was some weakness coming through from names like Diageo within consumer staples and Taylor Wimpey, the home builder, and also disappointed in terms of total performance last year. That was offset by strength in British American tobacco. And emerging market bonds, this is a really small component of the trust these days, 2.5% as at the year end, but it did deliver in terms of helping to achieve the investment objective and deliver strong returns for our shareholders overall. Looking at the same numbers, but this time broken down by sector, you can see that utilities was a very strong category. Industrials, I mentioned Siemens and Jasur fall within there. Basic materials was a very strong market category last year, and names like Vale, the Brazilian iron ore operator, helped contribute to that strong return, 35% in sterling. Telecoms, which we have a decent exposure to given the income element of the trust, was also a very strong contributor. Things like Singtel, Telefonica Brazil performed very strongly, helping to contribute to that overall figure. And at the bottom, as you can see, healthcare and consumer staples were the main laggards, although still performing and generating double-digit returns in sterling. And from a relative standpoint, it was actually only healthcare that was weaker than the market overall. And that's is an area that we have been adding to a little bit on that weakness, but I'm starting to stray into Martin's territory. He'll take you through the trades we've been doing over the past 12 months. And then looking at the next slide, this is where you get a sense of the income stories. So we know that a lot of people associate strong, consistent income generation with Murray International, as well as we absolutely seek to deliver capital performance as well. But looking at the income story, it was a positive year for the trust. Out of the 54 holdings that we held over the course of 2025, 42 of those companies increased dividends year on year. And looking at the individual stories behind that, we had a number of double-digit increases. The bumper dividend from Azur last year was very welcome. So this is the airport operator, which we've held for many, many years. 20 years we've held this name, 20 years plus actually. And this one has consistently been generating very strong cash flows, which it returned to shareholders last year in a sizable way. And that dividend yield at one point was 14% for Grupo Azur, so that was very welcome. But other names, even the lower yielding names such as TSMC and Broadcom, also delivered double-digit dividend increases. The flip side of that, we had 10 companies which cut dividends overall. This is not unusual in terms of that balance. And largely those cuts were expected. So within those list of names, you'll see a number of cyclical businesses, things like BHP, Rio, Woodside Energy. These typically do give you very strong income generating years and then they cut back in leaner times. But even in years where they cut back, they're still pretty decent yielders overall. And actually, our forecasts for the income in these types of companies was more conservative than reality. So there was no nasty surprises in terms of the income generated from this more volatile part of the portfolio. The one stock in that list which did cause a bit of a rethink was Global Wafers. This is a company based in Taiwan. It produces silicon for the semiconductor industry, and it cut its dividends by 42%. Meaning that it was no longer a really compelling income story in our view. So that did prompt a sale of that one stock. And the other one to highlight here is CME. This is a US company. It's an exchange business and it delivers a very strong income, especially in a US context. But the timing of it changed last year. So traditionally, it always paid a regular dividend and then a big special dividend at the very end of the calendar year. And this time it switched that payment, it changed the timing of that payment into the first quarter of this year. So mathematically, it was a cut. You'll see that falling by half over the course of 2025, but we have since recaptured that income. It was more a timing issue. So overall, a positive year, a positive story for income. And with that, I will now pass over to Marty to take you through positioning and tell you about the transactions that we did over the course of 2025.
Thank you, Sam, and hi everyone. My name is Marty Conahan, and I'm the other co-portfolio manager of Murray International Trust. And I'm going to just take us through, some of the changes that we made to the portfolio last year, how the trust's currently positioned, and then before moving to a little bit on the outlook slide. On slide 7, we can see the transactions last year. 18% of turnover, on the NAV is quite high, but markets were giving us some things to contend with last year. The portfolio holdings were giving us some things to contend with last year. So, that's fine. If and when that happens, we should take action. If you think about the top slices and the top ups, so that's us removing capital from and to existing names in the portfolio. That was really driven by relative strength or weakness. The tech names, some of the names like Philip Morris and Enbridge and Zurich all performing well. And just taking capital away from them and recycling that into some existing holdings which have been weaker over the same period. The alcohol companies such as Diageo and Pernod, the healthcare companies, which were quite, subdued throughout most of last year, and then some of the consumer discretionary stocks, such as Mercedes, Taylor Wimpey, just adding little bits at the margin, nothing overly aggressive, but just adding into some of the price weakness that those stocks endured last year. In terms of the purchases and divestments, if I start with the divestments, that would be a mixture of just investment theses really just having run their course. Atlas Copco had been a very, very strong performer with us. Its yield was kind of getting a little bit lower. We thought the valuation was perhaps up with events. So, we just felt it was prudent to, sell out of that position. And that's a name that we could well own if the price were to come off some. Names like SQM, that had sort of disappointed us on the income front the prior year. The lithium price had obviously corrected. We weren't getting the expected level of income from it, and we were short of the catalyst for that coming back, so we decided to exit that name. Banco Bradesco likewise was just a little bit more volatile on the income front. So that Brazilian financial, nothing wrong with the business, but we just used some of the strength that was evident in emerging markets, both in terms of Banco Bradesco and also China Resources Land, as the opportunity to kind of, just come out of those perhaps the lower conviction names within the portfolio. As Sam alluded to, Global Waste have cut their dividend, and that really sort of changed the investment thesis for us, so we sold out of that stock. OCBC, the Singaporean bank, we switched that into DBS Group based on the analyst's view. TELUS we sold out of. It's getting pretty competitive in terms of the Canadian telecommunications market. And we're a little bit concerned about the sustainability of the dividend growth of that company. And that is really why we are invested in telecommunications businesses. So we took the decision to sell out of that. And we also continue to reduce the fixed income exposure, which has been a theme of the last several years, continue to sell that down and move that into equities. In terms of purchases, we put in Rio Tinto from SQM. That still gives us some lithium exposure, but a more better, generally diversified miner. Intesa Sanpaolo, the Italian bank, saw the proceeds from Banco Bradesco, which allowed us to, secure that income a little bit better, perhaps less currency volatility and actually a higher yield. Infosys, the Indian IT service business, saw some of the proceeds from the reductions to the tech names in the portfolio. That allowed us to diversify the tech exposure into IT services, while also picking up yield. Names like Lowe's and Coney and Inditex, those are really high quality businesses in our opinion. And again, coming out of lower yielding tech names or reducing lower yielding tech names allowed us to move into those companies and actually pick up yield. So Lowe's is involved in the home improvement industry in the United States. Coney, the Finnish industrial, which is involved in elevator and escalator market, and Inditex, which is the owner of the Zara brand, is its main brand, and one of the few companies that actually makes that middle ground of retail work. Banorte, Mexican financial, super well capitalized, great yield, saw the proceeds from the Pemex bonds. And then finally, towards the end of the year, as we sold out of TELUS, we put that into Veolia Environment, which is a utility which is involved in, water, energy, sort of efficiencies and waste management operations. So an active year overall, but the market did give us some certain things to contend with, and stocks within the portfolio certainly did the same. So an active year overall. If we move on to slide 8, and we can see the top 10. One thing that I think is interesting with regards to the top 10 is that in prior years, we've certainly had companies, at least 2 or 3 companies that have been bouncing up against the sort of upper limit in terms of the position that we're allowed to take in that single stock, which historically has been 5%. At times Philip Morris has been up against that, Grupo Assur, some of those tech names at times have been up against that sort of upper weight. But at the moment, you'll notice that upper limit is sort of just sitting at 3% in terms of the biggest holding. And it's given an environment we sort of feel kind of quite comfortable for that, or with that. It's quite a tricky environment at the moment. So, feeling confident enough to have really sizable exposures in any names, probably indicative of that environment, just seeing some of the bigger holdings being slightly smaller than perhaps they have been in prior years, but a mixture of businesses from across the industries and the geographies, and a mixture of high yield and lower yield growth opportunities within the top 10. On slide 9, we can see the sort of asset allocation from the country or the regional perspective. We do remain, underweight the United States. That is not a negative top-down view. The Sam and I take on the market. It's the single largest country position that we have in your portfolio. But we do at the moment still have a preference for diversifying across the globe better, to other areas such as, Asia, Latin America, in Europe, and whether that's driven by relative value or relative quality, or relative yield, or perhaps a combination of all three, we still have a preference for, making full use of the global remit that we are, allowed to have, and having a truly global portfolio. We still have nothing in Japan at the moment. That is not for want of hunting on our part. We do have some names on our watch list. Perhaps some of the more recent volatility that we've been seeing might present as an opportunity there, but we will remain patient. We're never keen to be chasing stocks, but nothing in Japan at the moment, and a truly, global portfolio. On slide 10, we can see the positioning in an absolute and relative sense at the industry level. And what I would sort of point to here is that the sort of extremes, both the over and the underweight, so the telecoms, consumer discretionary, industrials, that is really just driven by the yield requirement of the trust, that objective to try and cover the dividend, and that is the real primary driver of the underweight and overweight to those respective sectors. If you look beyond those sectors, you'll notice that there isn't not anything really overly aggressive at the relative positioning. Sam and I don't really take very strong sectoral views, and that's really evident in the current positioning. So the real extremes at the sector level are really more driven by the yield requirement, as much as anything else. And then on to the next slide, please, and we'll cover off the outlook. Now, Sam and I have been working on presentation slides and nice fancy charts to try and cover off the outlook. But every time we finished one, it just became immediately almost out of date. So we've just went with some bullet points. Market started off the year this year in quite fine fettle. The market, the fund itself, was up about 10-11%. By the end of February, and markets had begun the year in a very strong vein after a very strong year last year. But obviously, the events of the last few weeks and the conflict in the Middle East has certainly changed that, and it does have and present a lot of unknowns with regards to where we go from here. There's obviously been a quite noticeable impact to the oil and gas prices, and traffic going through the Strait of Hormuz. Geopolitical tensions were sort of already elevated coming into this year. They are now even higher than that. And that really just has unknown implications at this point with regards to inflation, with regards to interest rates to deal with any inflation that subsequently does come through, and what that ultimately does with regards to global growth, with regards to this year. So the outlook at the moment is very, very, very tough. And what we'll be focusing on are the sort of knowables, or the things that we feel we can at least know as best we can. And that's to focus on the businesses themselves that we are invested in on your behalf, those 52 companies that we put into the portfolio, and the companies that we don't. When we focus on that, when we focus on what the investment objective is, and the investment time horizon that we're expected to operate around with regards to delivery of that, then trying to negotiate such noisy periods such as this, I wouldn't say it becomes easier, but it certainly becomes a little bit straightforward. So that's what we will be doing, focusing on the things that we can control. And the last few years, we've had this this cycle of inflationary cycles and interest rates and geopolitical tensions and bouts of market volatility, which also present volatility and opportunity and the trust has been okay through that. You know, the income picture at this point with regards to this year looks particularly robust. We haven't been overly active as yet through the volatility, but that doesn't mean that we won't be, because on the whole, I guess we are, you know, pretty comfortable with how the portfolio, you know, is currently positioned given the environment that we find ourselves in. So a very, very difficult outlook, but, you know, we just focus on what the investment objective is. And when we do that, you know, things become, you know, a little bit more straightforward, perhaps. That's all I was really going to cover today. We would much rather spend the remaining time that we have, you know, addressing any issues or concerns or questions that you may have. You know, so with that, I will pass that over to Evan, and then he can handle the questions that you may have for myself or Samantha, or indeed our chair, Virginia. But thanks very much for joining us today.
Thank you very much indeed, Marty. We'll now move on to the Q&A session. We've had a number of pre-submitted questions. A lot of them will cover similar themes, and so I'll try and group them together as far as I can. Let's start with the dividend, if we could. Sam, can you talk about how the geopolitical tensions that Marty was referring to might affect the trust's ability to sustain its dividend growth? What's the outlook for the dividend progression and the revenue reserves?
Absolutely. That is an excellent place to start. So in terms of what we're hearing from companies, it's very easy to say is the conclusion. So the war started about 6 weeks ago now. And we always wait to hear from the companies themselves rather than try to make predictions or make sense of a lot of the noise which can change day to day in terms of ideas behind what may or may not impact dividends. But as far as the trust is concerned, what drives our approach and the board's decision on the dividend is looking at the companies, really taking at it on a stock-by-stock basis. And then we're very fortunate that we have very healthy reserves there if we had, you know, an awful situation with regards to dividends. Now, we would be surprised if that happened, to be honest. I mean, what we're hearing so far is that we have, for this calendar year, 2026, full year dividend declarations already declared for 20 of our, you know, 52 names that we currently own in the portfolio. And that's been pretty good. You know, we've had 17 dividend increases announced for this year. We've had one company hold that dividend flat, and we've had 2 cuts, which were largely expected. Those were from Mercedes and BE Semiconductor. And both of those businesses, like a lot of businesses, they are making their dividend calls for this year based on performance last year. So there will certainly be a lag. It's something that we will monitor. We do keep track as we get more and more dividend announcements coming through. What that means for our calculations. We make our own estimates as well as having forecasts come through on a monthly basis from our fund accountants. So that means we have time. You know, if something does change dramatically and we need to take action in the portfolio, we will. And having those reserves is fantastic. You know, we've got 85 million in reserves, which is now way over 1 full year of dividend payments in terms of us paying out to our shareholders. So it's not something that we are freaking out about. We will monitor it as always. You know, we coped fine during COVID. We coped fine during an awful lot of tariff uncertainty and noise last year. And so in some ways, this is becoming actually normal. I'm sad to say that for the reasons, but this big picture events, you know, lots of question marks, uncertainty is becoming something that we're having to deal with more and more. And we always just fall back on what companies we own and having those reserves there for a rainy day.
Thank you, Sam. And so related to that, Virginia, if we could come to you, the yield on this trust has fallen, and you know, it used to be over sort of well over 4.5%. How does the board read that, and is there a concern about the fact the dividend yield has fallen?
Sure, thank you for the question. So I think the important point is that dividend yield is a function of share price. So if we look at our share price at the end of 2024, it was about £1, I think, approximately lower than it is today. And that's the result. That's what has resulted in that decline in the yield. And I suppose from a board's perspective, we obviously think that yield is an important thing to consider. But we also very much focus on the revenue account, as Samantha has just described, and dividend growth. And we're hoping actually to increase dividend growth by about 5% this year.
Thank you, Virginia. If I could come to you, Marty, how has AI affected the portfolio? And is it positive? Is it negative? And where do you see the potential future opportunities regarding AI?
Yeah, that's a good question. I think on the whole for the portfolio to date, it's been a positive. We have a number of stocks in there which are sort of primary beneficiaries of AI. You have TSMC, which is one of the primary enablers on the manufacturing of the very high-end chips that are required for AI. We have Broadcom in the United States, which is more of the sort of infrastructure, the switches, the networks that are getting into these AI data centers. And it's been a really, really strong performer for the trust. You also then have exposures via things like Samsung, which has really caught up with regards to the high bandwidth memory that is required also for AI to run. It's caught up with competitors like SK Hynix very, very well, and that's been a strong driver. So the exposures within the trust has been a beneficiary. We don't have any exposure to what are called the hyperscalers, the companies that are spending billions and billions of dollars building out these data centers. Because A, they don't pay dividends which are attractive enough for us, and B, we are a little bit concerned about the sheer scale of the capex companies that go into heavy capex cycles, particularly when they're coming from a asset light business model, tend to lag. So they're not suitable investments anyway, but we do have some concerns around that. I guess some of the more peripheral areas would be in some of the power generation sort of areas, utilities. The AI data centers use a lot of power, need a lot of electricity. And some of the software or some of the platform operators more recently, the market seems to be wrestling with itself whether they can use AI to their benefit or whether AI is going to actually do away with their business model. And you've seen real weakness there with regards to names like Accenture or Sage or SAP. And we think that, that potentially that is a risk for some of those companies, but we do also believe that some of those companies, AI presents an opportunity. So a mixed bag, threats and opportunities, but for the portfolio as a whole to date, it's been a positive, we think.
I'm still getting a lot of questions about dividend growth, dividend yield. Sam, there are a couple of statements here that I think we probably take together. Dividend growth is as, if not more important as yield. Can you elaborate? I think Virginia's already talked about 5% growth. At the same time, the trust yield has fallen. Should you be looking more at cheaper markets with higher yields?
Yeah, as Virginia explained, the trust yield itself has fallen largely because the share price has done so well. And so if you look at the underlying running yield of the portfolio, so look all the positions that we own, look at how much income is being generated from those companies and the weights we have in those companies, that's still really solid. That's about 4.3. So that's not changed. Although the share price going up has meant that the yield on the trust itself has come down. And we can absolutely work with that. That 4.4% roughly running yield means that we are in the right ballpark. Can it go higher? It absolutely can go higher. But what we don't want to do is do anything reckless, really. We want to be invested in solid companies with steady dividend growth. And we're looking out years with these businesses. We're not just looking at what this year's income is going to be. We want to see evidence of growth going forward. We want to see resilience. And all these things coming together mean that in our view, we have a pretty solid picture in terms of the income generation of the trust. And the flexibility we have is fantastic. It's truly global. We're invested in 24 different countries at the moment. Every single market sector we have exposure to. So again, that all builds resilience. It means we can flex if need be, if any particular component of the trust is looking like it might cause us an issue. And, we saw it in COVID during times where financials were just told to cut dividends in certain parts of the world. It means you do have that flex to go elsewhere. So it's something that has absolutely been at the forefront of our minds. It's been interesting seeing that dividend yield on the trust coming into like 3.5%. That's really unusual, but that's all to do with the share price being strong. So it's not for the worst reasons out there. And as I say, the underlying income generation is really solid in our view, so nothing overly concerning. And with some of the income that we generated just from new companies, we are finding high ideals in income. Banco Banorte, Marty mentioned as one of the most recent introductions. It's got an 8% dividend yield, really solid, backed up by cash flows. But it's that balance, you just don't want to swing too far any one way because you can come into trouble. But the dividend picture is really quite pleasing in our view.
Yeah, I hope we've addressed those questions. Sam, you mentioned, I'm coming to you, Marty, about asset allocation. Sam mentioned you're in 24 countries. We've got a couple of questions here about Asia. Any ideas for Australia, and also a breakdown of your asset allocation or your country allocation within the Asian region? Because the questioner sees Hong Kong has experienced its first proper recovery since 1997.
Yeah, I mean, the trust's always had a reasonable exposure to Asia, really driven by the companies. If you look to, sort of break that down, in terms of Hong Kong or mainland China, we have, sizable exposures to both Ping An Insurance and then also Hong Kong Exchange and Clearing, which is a very much a sort of beta play on that market. Great cash flows, high barriers to entry, really, really attractive dividend growth. We then have exposures in Taiwan via TSMC, which we've already mentioned. Then Hon Hai on the EMS side, and the mass manufacturer of electronic goods. We also have SCB, which is a bank in Thailand. We have Telkom Indonesia in Indonesia. So, the exposures are really, really well spread across Asia. We also have Infosys, IT services company in India. So a reasonably sizable exposure to Asia as a whole. We don't have anything in Japan at the moment, as we mentioned on the call earlier. But with regards to Australia, some of the mining companies, whether they be, Anglo-Australian, would be potentially considered within that exposure, whether that be BHP and or Rios. In terms of some of the other exposures that you look at within Australia, the banks are generally pretty well capitalized and generally offer, reasonable yields. Medibank on the insurance side is also a reasonable operator. But we're just sort of mindful of the overall exposure. So I wouldn't say there's anything necessarily close to going into the portfolio from Australia. We are mindful of that existing exposure to Asia that we already have, which is mentioned is reasonable, and that's how it's currently broke down at the moment.
Thank you. And just a comment has come in about my previous question. Please do not invest in poor quality companies for the sake of higher dividends. Stick with high quality companies in these difficult times.
Wise words. Thank you.
So, Sam, we've talked about Asia. Let's move across, go to the other side of the Atlantic. Do you foresee remaining extremely underweight in the USA?
The short answer is yes. But to explain why, we don't start off by targeting any particular weight in a country or a sector even. It's driven by, the trust's mandate being met, being delivery of that mandate, and also just making sure that it's truly global. There's plenty of options if people really have a strong view on a particular market and they can go there directly. What we would put out, Marty's already mentioned, is that the US is at its largest weight that it's ever been. So this is not a negative view on the US market or US companies. We do find opportunities there that help to tick a lot of boxes in terms of delivering the mandate. But if we were going to be benchmark weighted, even our new benchmark, which is 50% in the US compared to 65 in, for example, the FTSE All World, that would make delivering our mandate very, very tricky. The S&P has a dividend yield of just over 1%. So if we're trying to have a covered dividend, we're trying to, keep that running yield about 4.5%. Mathematically, you probably could do it with a 50% weight in the US, but you would be chock full of the same kind of businesses that we already have. It would be more healthcare, it would be more telcos, and we don't want a lot of duplication in the trusts. And there's no need to be there. I think having the expertise that Aberdeen have in terms of people allocated and visiting companies all over the world gives us a great starting point in terms of trying to pick companies. But it's something that we should make sure people understand. So it's not a case that we have a negative view on a market. It's not the case that we're trying to be different for just the sake of being different. It's about delivering the investment mandate and not being afraid to be different, which has served us well over the years. And we've heard from our shareholders that it gives them a valuable tool by not being, a copycat of something else or be a closet index trust. It is truly global and for the right reasons, we believe.
Thank you. And that sort of you touched on a point that has links into another question that's come in. You've got a relatively, not quite sure, Sam, I think probably, got a relatively concentrated portfolio of 51 stocks. Given that some other investment trusts, the peer group, have around 150, is there a particular reason why you choose to be more concentrated?
Yeah, that's a good question as well. So we don't have to have 50. We could have 150 if we wanted to. Um, how we've arrived at that sort of number over the years is because we do put a lot of time and effort into company analysis before we would ever invest. A company tends to sit on the watch list for quite some time. Analysts have been going to see it. Marty and I have debated an idea. So when you're going to invest, you want it to be sizable in the sense that you don't want to tinker too much. 1% tends to be the minimum position with a view to building that over time, potentially. So that gives us a fairly decent starting point, 1%. We also track every single company in terms of its income generation. That's a lot easier to do with 50 names than it is for 150 names. So again, it means you have a much closer better idea about what's actually going on in your portfolio. If you have that kind of number of names to work with, but also still gives you a range of different companies, gives you that diversification that we also want. So there's no hard and fast rule, but we've made this work, having that roughly number of businesses. It's given us the diversification we need. It's given that level of insight that we want to have in terms of getting to know the businesses better and being able not to have any surprises popping up in the portfolio that's going to take us unawares from an income standpoint. But we don't want any hard and fast rules. What we wouldn't want is to have, that we sell a name and we have to immediately replicate it with another name, So it's nice to kind of have a bit of flexibility around number of names, but no, I wouldn't expect it to go up to that kind of level, 150. That's not tend to be how we do things.
Thank you. So we've done Asia, we've done the US, and then we come back to home. And Marty, UK. Are UK stocks currently attractive?
Are UK stocks currently attractive? Don't know if we're necessarily believers in sort of such wide sweeping statements. As I've covered already, the UK section of the portfolio was one of the more frustrating, areas from Sam and I's perspective in terms of the performance. It was still positive in an absolute sense, but was certainly behind the wider market returns. So that we've been doing a lot of work on the names that are within that allocation, within your portfolio. What I think we would say is that there are certainly some great businesses within the UK, and actually, and probably frustratingly from our perspective, where we see a lot of really, really great companies and opportunities in the UK are probably just a little bit too far down the market cap scale for us. You think about XPS Pension or Kainos or Softcat or Morgan Stanley or Galliford Try. There's a number of great small and mid-cap companies in the United Kingdom, and they probably just could do with a little bit more support perhaps, and certainly perhaps a little bit more protection. I think sadly too often some of these great businesses are snapped up by overseas businesses and never really get a chance to make it into being bigger constituents of the main indices. So for us, it's about kicking the tires of the existing UK names that we have, because as we've mentioned, one or two of them have been problematic And there are certainly some great UK companies that are great investment opportunities. But we wouldn't say that the UK as a whole, just like we wouldn't say that for any country, is a great market to be invested in.
Thank you. Virginia, if I could come back to you, you talked about the AGM in your introduction and how important it was for the votes. Can you tell us how big a stake activists have in the shares of Murray International?
Okay, so it's really quite difficult to see whether you have an activist on your register, your shareholder register, primarily because they don't tend to go in their own name, and they frequently use financial instruments such as contracts for difference, which hide their holding. It's obviously something we review very closely. We believe our worst case scenario at the moment is a de minimis holding of about 0.1%. We're probably being very conservative in identifying that as an activist holding, but it's really important that we do stay on top of this. I mean, we're not actually a terribly interesting proposition for an activist. We're fortunate to be trading at a premium or a small discount, and so certainly at the moment, it's difficult to see what an activist would gain from holding a shareholding in Murray.
Thank you, Virginia. Yes, and we're trading at a premium the last couple of days. We saw a lot of discounts moving out over towards the tail end of March. Funnily enough, that seems to happen quite often. It seems to be to do with tax year end and so on. Obviously, there were issues in the Gulf which affected discounts as well. But we've moved back to a premium, which is very nice to see. Virginia talked about contracts for differences and so on, and complex investment products. Do we hedge? Do we hedge currencies because we're invested in these 24 markets?
That's a good question. The simple answer is no, we don't hedge currencies. We do look at this from time to time. The board actually asked us at the strategy day last June to again have another look at this, speak to people within Aberdeen to see how it would work in practice, and then decide if that's still the right approach. And the conclusion is that we think it is the right approach. So out of those 24 different countries, there is exposure to 17 different currencies. We only invest roughly about 9-10% at the moment in UK assets. So that does leave a lot of moving parts out there. And it's something I said we could do, even do it partially. You could choose even just to do the US part of the portfolio, for example, or choose just to do the emerging markets currencies, which typically are more volatile. But it's no surprise that that would be more expensive to do, some of these currencies that do move around a lot more. And the reason why we've always chosen not to is because we have seen over the long term that, you win some years, you lose some years, but over the long term, the impact is quite small in terms of currency movements. And it's very unusual actually to get a year where everything either works for you or against you from a currency perspective. So in 2024, we did actually see sterling strength as a headwind. It meant that income being generated in all these other currencies, when it was translated into sterling, you're not getting quite as much as you had predicted at the start of the year, for example. But typically, the following year, that reverses to an extent, and that did happen going from 2024 into 2025. And the last year, there was a meaningful move in currencies, all changing the one way against sterling was the reverse. Actually, so going back to 2016, sterling weakness linked to Brexit helped us in a currency standpoint. So we think that over time, if you are looking at these things over a long period of time, you have to kind of take it on the chin up to a point when it's working against you, and then don't get too carried away either when you get it working for you. But it's something that, we do think it's sensible to look at, every few years, perhaps, like actually go in deep and see, is this still the same situation? Are the board and ourselves still comfortable with this approach? But at the moment, given the natural hedge that's in there, so many different countries and currencies represented, we're comfortable with not being hedged at this point in time.
Thank you. Talking about comfort, gearing is currently about 4%. Just Marty, what's the maximum you'd be prepared to go to, and what would trigger an increase in the gearing?
I mean, gearing is first and foremost a board decision, and it's done. You know, we discuss gearing at every board meeting with the board, their current levels, where we feel comfortable. Are we interested in taking gearing on? You know, should we be paying it back as and when it comes due? So at the moment, yeah, there's about 110 million nominal of gearing, and that's split into tranches, one which matures in 2031 and another which matures in 2037. And they're on a blended rate of just around about 2.5%, give or take. It's discussed at every board meeting. You know, we did de-gear the trust the last few years, and we paid back 90 million over the last few years, just as gearing was coming off of a rate that started with a 2. You know, it was going to cost us 6 and something to put that back out or to roll that over, and that's no longer an automatic yes, we believe. You know, when you're starting to get towards what the long run return of equities is, you know, we ask ourselves very, very simple questions with gearing. How long can we take it out over? How much is it going to cost? And therefore, do we believe it's in shareholders' interests? Because we don't have to have it. It is helpful to have it, and it is useful to make use of the structure of investment trusts, but it's got to be in shareholders' interests. I think in terms of where we would feel comfortable, that nominal 200 kind of feels as a potential ceiling, and that would take gearing up closer to about 8% if we were to go there again. So we'll keep our eye on how much it would cost. As said, it's discussed every single board meeting. But if we were to take it back up, that would probably be a possible ceiling that ourselves and the board would have in mind.
Thank you. Again, I'm not quite sure. I think, Marty, can I stick with you? What is the future for equities compared to fixed interest or even cash, as far as the portfolio is concerned?
As far as the portfolio is concerned, you know, we have had allocations to fixed income in the past, really just twice in size. So in the early noughties, we took it up to about 25%. And that was purely made up of gilts and treasuries. And the reason that was done is because equity yields at that point were really, really tight everywhere. And we were struggling to cover that, you know, natural running yield of the portfolio of about 4.5. Treasuries and gilts were there offering that, so they helped us deliver the investment objective. Global financial crisis happens. All of a sudden, equity yields are working again, and that situation gets reversed quite quickly. We did it again sort of through 14, 15, and this time it was an emerging market, debt and government, both corporate securities, and it peaked at about 17, 18% of the NAV of the portfolio. Direction of travel the last few years has been to sell that down. We sold it down into COVID. We sold it down again into Russia, Ukraine, and as mentioned in the call, you know, we've been selling it down again, and they've even had another bond mature thus far this year. So longer term for us, we think that, you know, equities over fixed income over cash, that should probably be reflected in the portfolio going forward. But we are grateful that we do have that flexibility to potentially explore fixed income as an opportunity, but it would only really be done if the equity market was posing as an issue with regards to the delivery of the investment objective. Sam and I tend not to make views on equities over fixed income. We want to probably have an entirely equity portfolio, just for simplicity more than anything else. So we've been selling it down. It is there as an option, but yeah, equities over fixed income over cash would be our long-term view for the portfolio.
Thank you. I think we're getting to the end in terms of time and the number and the questions that have been coming in. So Marty, can I just summarize? Can we come back to you for a final question? Why is Murray International better positioned than the wider market for a sustained increase in global inflation?
Because if we think about the environment that we've been in really since coming out of COVID, we've had a more, inflationary cycle. We've had an interest rate cycle, and there's been, economic and market cycles to contend with. The trust's been absolutely fine through that. And we would argue that that's actually a more natural environment to be operating in. If we think about where inflation was, abnormally low interest rates, negative interest rates, coming out of the global financial crisis right up to, pretty much 2020 in the COVID pandemic. So I don't think there's any real reasons for us to be concerned about the difficult environment and the tricky environment that we find ourselves in, because the trust has, behaved absolutely fine in terms of dividend growth and capital growth through, what we've been seeing these last few years. So it's really no reason really for concern in our minds. The trust has performed well. It's that level of diversification that we have. We're not beholden to any one area of the market, either geography or sector. We are making full use of the global remit that we have, and it's that investment objective. It's where that investment objective takes Sam and I in terms of how the portfolio is constructed and the style and the characteristics that are inherent in it. So yeah, it's been fine the last few years, and there's no reason for us to believe that that shouldn't be the case if we remain in this uncertain and fragmented market going forward, because there's opportunity there for us.
Thank you, Virginia. Thank you, Marty. Thank you, Sam. And thank you all for joining the call. I hope that you found it useful. We've covered quite a lot of ground, and I hope that we've answered all your questions either in the presentation or in the Q&A afterwards. Before we end, please can I reiterate how we would really appreciate it if you could vote your shares, even if you are unable to attend the AGM itself. But we would, of course, welcome you to the AGM on the 23rd of April. The presentations will be uploaded to the website in due course, but in the meantime, thank you very much for your time.